I want to talk a little bit about mortgages. Now, what are they? They're actually long-term loans secured by real estate. So, very common. People want to buy a house, they take out a mortgage. But you could also use them to buy commercial property, etc. Now, usually they're what are referred to as amortized loans. And in this case, a fixed payment is made each month, and some of that fixed payment goes to principal, and some of that goes to interest each month. Now, there are some mortgages that are not amortizing. There are things called interest-only loans, and they became popular during the real estate bubble when house prices just seemed to be going up and up and up, and people didn't really care about paying off the balance of the loan, so they take out an interest-only loan. It was less expensive, and when they, because they expected the price of their house to go up, they were always increasing the equity. So if they sold their house, they still sold it at a profit. Now, what are some of the characteristics of residential mortgages? Usually we think of them along three dimensions: the mortgage interest rates, the loan terms, and the mortgage loan amortization. And again, there are different types of amortization. The traditional one, you get a 30-year mortgage and you're paying the same amount every month, and the same amount is being, actually, you make the same payment, and the amount that goes to interest and principal changes over time, because as the balance gets smaller, less goes to interest, more goes to principal. You can also have mortgages where there's a balloon payment. You pay for 5 years, and then at the end of 5 years, you have to pay off the balance. People would do that by refinancing. Now, what determines the rate on a mortgage loan? Well, the general rates on treasury bonds or some other long-term security. Longer-term mortgages are going to have higher rates. That's why a lot of times people like to get these shorter-term, sometimes variable rate mortgages. If you can get even a fixed-rate mortgage, a 10-year mortgage instead of, or a 15-year mortgage instead of a 30-year, you'll generally get a lower interest rate. You may also pay points. The person who gets the loan sometimes pays points up front. For example, you might pay 3 points. That's 3% of the loan amount, and that's in order to get a lower interest rate for the mortgage loan. So if you're going to be in the house a long time, it may be worth paying 3 points up front and getting a lower rate for this 30-year loan. Of course, you may wind up refinancing should rates fall, in which case it may not have been profitable to do so. Mortgage loans contain lots of legal terms. Most of them are there to protect the lender from financial loss. So one is collateral, which we hear a lot about. Collateral is just basically what is backing up the loan should you not make your payments. Now, in a mortgage loan or a real estate loan, it's quite obvious. It's the real estate. It's the home that's the collateral. Down payment is the amount, a portion of the purchase price paid by the borrower. So before you buy the house, you may be buying a $200,000 house, but you may put $40,000 down, so you're only borrowing $160,000, so $40,000 down payment. PMI, or private mortgage insurance. This is insurance against default by the borrower, used if the down payment is less than 20%. Because in this case, the borrower's worried, or I'm sorry, the lender is worried that should the house go down in value, as it did during the recent housing bust, and you default on the loan, now all of a sudden they have a $200,000 loan and the house is only worth $150,000. So they make the borrower buy private mortgage insurance, and that private mortgage insurance will pay them for that loss. Other qualifications include things like credit history, employment history. These are things that were neglected during, again, the housing boom. That's why we've had a lot of defaults. There were a lot of people who bought homes who did not have their credit history checked. their employment history. Sometimes they just lied. Sometimes there were actually no doc loans where the lender didn't even bother to check anything. Lenders will usually obtain a credit report from one of the credit reporting agencies, and they can do it quite quickly online. They can check your score immediately. So if you call up, you want to refinance your house, you want to go through an application over the phone, they'll be sitting there at the computer calling up your FICO score. And this ranges from 300 to 850, with average being somewhere in the 660 to 720 range. But the higher your score, the better rate you're going to get. And the score is determined by your payment history, how much debt you have, what your income is, things like that. The higher the score, again, the better. So having a good credit report, paying your bills on time, not having too much debt will oftentimes help you to get a much lower interest rate on your mortgage. Now here's an example of a loan amortization schedule. And if you're interested in this, I'll provide a link to a tutorial where I actually show you how to calculate this in Excel. But this is the case where it's a 30-year, $130,000 loan at 8.5%, and the monthly payment is $999.59. And you can see that stays the same. And here they just show you which payment, the 1st, the 24th, the 60th. Obviously they could show you every month, but the table would be too large. And you can see that in the first month of the $999.59, almost all of it goes to interest, very little to principal, because you have a fairly big balance. But after, let's say, 60 months, where you have been paying for 5 years, your balance is a little bit smaller. So while it's still a fairly large percentage going to interest, more is starting to go to principal. And if we get out here to 240 months, that would be 20 years, you can see that now just a little bit more than half is going to interest, and the rest is going to paying off the loan balance. So with time, and in the final payment, you can see that there's almost no interest to pay because you don't have a very big balance. Almost all of your payment goes to paying off the principal. Types of mortgage loans, they're insured versus the conventional mortgages. Okay, if the down payment is less than 20%, PMI insurance is usually required. That's an insured loan. Fixed rate mortgages, where the interest rate is fixed for the life of the mortgage. These are less risky because you don't have to worry if you're a borrower, if you are buying a home, that interest rates will go up and your payment will go up. And there are adjustable rate mortgages where the interest rate can fluctuate within certain parameters. For example, it can perhaps go up 2% a year with a maximum increase of 6% over the life of the loan. But a 2% increase in the mortgage rate can increase the payments by quite a bit. Not by just 2%, but by hundreds and hundreds of dollars depending on the size of the mortgage. So, people will get these adjustable rate mortgages because the rates are much lower, and so the monthly payment is much more affordable. And when you're a young person starting out and buying a house, you don't have generally a very large income. This works okay, but if interest rates shoot up, many of these people wind up getting into trouble. Loan servicing. Most mortgages are immediately sold to another investor by the originator. And the reason this is done is it frees up cash to the originator being the bank, for example, to originate another loan and generate an additional fee for originating that loan. Okay, lenders or loan originators, they get a fee for originating the loan. There's usually an application fee. They may also get a fee for servicing the loan. So you may send your mortgage payment to JP Morgan Chase, but they don't own it anymore. They get a fee for keeping the records, for collecting the money. They get a fee for originating the loan, but they don't own the loan anymore. They pass on the interest and principal to those that purchased them. Um, what happens is the originator packages the loan for an investor, and the investor holds the loan, and there may be a servicing agent that handles the paperwork. Okay, the secondary mortgage market. Well, the secondary mortgage market was originally established by the federal government after World War II, when it created Fannie Mae to buy mortgages from thrifts. Again, this was done to try and encourage home ownership. And by doing this, that you were able to take a security, a mortgage that was not very liquid, not very marketable, and by packaging them together, you could get people to buy these securities, which hopefully they were hoping would free up money so that so that thrift institutions, that is savings and loans, would write more mortgages and more people would be able to buy a house. And there was a lot of growth in this in the early to mid 1980s, and it's continued to be that way in the U.S. Securitization of mortgages developed because of problems dealing with single mortgages. Okay, so this is the idea of packaging them together. So they get packaged together as a pool of mortgages, and then they get sold off. Now, I have a separate tutorial that talks about securitization, and another one that talks about collateralized debt obligations, and I'll provide the link here. And these go into more detail about how the secondary mortgage market, or the secondary market for debt obligations like mortgages, is created. But this is a basic overview of the mortgage market, and there's actually a lot more details that you can pick up by looking at both of those tutorials.